Hi, this is Terry, and now we're in Chapter 8, which is Current Liabilities. Chapter 7, of course, was current assets. We're in Current Liabilities now. Again, same issue with some of our terminology here. Let me get this little toolbar out of the way. There we go. We're going to have different financial ratios that we can use to keep track of how well our business is doing. So one of the first ones here is the payable turnover. So it's cost of goods sold plus the increase or decrease in our inventory divided by average accounts payable, and that tells you how many times our inventory turns in a year. Then if we take how many times the inventory, or 365 divided by how many times the inventory turns, that tells us in how many days. So if it's taken us, 45 days to take our products and get it sold, well, that might be fine for somebody like Sears that has all durable goods. It takes them 45 days to sell a refrigerator, stove, oven, etc. But obviously, if you were working at a produce or a fish market, 45 days would be pretty old inventory. So again, they're just numbers you keep track of and then make business decisions on what's going on. The longer that goes, if you're greater than 30 days, then you always risk the potential of being reported as 30 days past due to the credit bureau. Current liabilities versus long-term liabilities. Current is anything that's going to be paid within 1 year, one operating cycle. Long-term liabilities, which is our next chapter, are liabilities that you owe that you're not going to pay within 1 year, such as a mortgage on a house or a factory building you're not going to pay in 1 year. Definitely determinable liabilities is the fact that you absolutely know the dollar value. So you don't have to worry about it being contingent liability. Definitely determinable would be things like payroll. So you know exactly who worked, how many hours they worked, and what is the payroll, wages payable that you owe. If we go to notes payable now, if you take out a note, then, for example, we're going to take out a $5,000 note, then we would record that we received the cash and we now have that liability. So assets equals liabilities plus owner's equity. Your asset cash goes up, your liability goes up. When it comes time to pay that liability, so this is 60-day note, and it comes time to pay it, then what we need to do is take the notes payable off the book, but also record that we're going to have interest expense. So the cash that we pay out to pay our loan back is going to be the dollar amount we owed plus the interest. All right? If a fiscal year end came in between, then this would be interest. Interest expense would become interest. Let's see, what would we have here? Notes payable, cash. We would not have the notes payable. We would just have the interest expense and interest payable here. That would be only if we crossed over a time period and say this is a 60-day note and 30 days have gone by, we hit the end of our fiscal year, then we'd have to get the interest expense for 30 days into this time period and have the interest payable. Then when we actually paid the interest or paid the note off 30 days later, we'd be in a new fiscal year. Then we'd have 30 days more of interest expense. We'd take the interest expense, let me just write it out here. We'd take off the interest payable that we'd previously recorded. We would take the notes payable off the book and then put a credit to cash for the entire amount. All right? Accrued liabilities happens when you sell a product and you're going to sell it for $100. What you're going to do is charge people you're going to pre-collect the taxes for them. So in this example from your book, we have a sales tax and an excise taxes payable. So you're going to record your sales at the dollar amount of what the sales are. You're going to collect the sales and all the taxes as the cash, and then you're going to put those appropriate amounts into a tax payable. Then at the end of each month or at the end of each quarter, depending upon what kind of tax it is, then what you're going to do is take the payable off the books and submit that cash to the appropriate taxing body. Most of those are done just through your bank, that you fill out a form. You put your identification number on it. You put what kind of tax it is, your tax ID number. Then submit it to the bank. The bank will take it out of your account and submit it into the government's account. Then what you have is you have that slip for your records that at the end of the year when you file your taxes, then you total it all up. You look to see what the grand total is that you owe them. You look to see the grand total what you have deposited, and then you make up any difference then when you file your taxes. The last topic here in this section that I'm going to do, or I guess I got two more, payroll and vacation pay. Payroll is an issue where you're never going to get the employer and the employee come to grips with this. And I'm just going to draw this as the dollar here. So we got a good old American greenback here. And there's a certain amount of this that just goes to taxes, and then the rest of it becomes the person's paycheck. So when we're talking about employee taxes, then out of that dollar, you're going to take out federal income taxes, state taxes, FICA, Medicare, insurance, pension. So you're going to take all those taxes out. So that's why the employee will yell and they'll say, well, I'm only making 70 cents for every dollar that I make. I only get 70 cents cash. And they talk about how awful it is that, the taxes are. So you would record the wage expense and the wages payable, or cash if you pay it, including all of these taxes. The employer then has more taxes that they have to pay on top of that, so they have to match the other 7% of the FICA, any Medicare, any medical insurance, their portion of the pension, and then there's a federal unemployment tax and a state unemployment tax that I think somewhere around 3.5% combined. So for an employer, it costs them, for every dollar, it costs them $1.30 in taxes, but the employee only receives 70 cents. So the employee is always going to argue, I'm not making enough money, and the employer is always going to argue, you make too much money. And the last one here is product warranty and vacation liability. And the idea here is if you sell a product within this time period, you oftentimes, a way to get people to buy it, especially items that are, like electronics that are prone to breaking and not working. People aren't going to buy it if they don't have some kind of warranty. Washing machines, ovens, stoves, cars, whatever it is. So you have to record in this time period the idea that you're going to have an expense. This is the matching principle. So you would put in product warranty expense and product warranty liability as a debit and credit. The issue becomes later then when somebody does bring that back in, then you're going to debit the liability to take it off the books, and then you're either going to give them their money back, or you're going to take an item out of inventory to replace it, or you're going to have wages payable that you just pay somebody to fix it. But the idea is you have to estimate that warranty to get that expense into the same time period as your sales, even though it will be later that somebody will bring that product in and say it's broken, it needs to be replaced. vacation pay runs the same way. That you're going to give them the vacation pay expense and the vacation pay liability, and that it isn't till later that the liability comes off the books, and then you're going to give them cash or pay, give them an extra check. So again, these are estimated liabilities that you put on the books and then take off the books once time has gone by and you know exactly how many units were broken or how many people do take vacation. All right. Check your book for the calculation. Vacation pay has, a certain formula has to follow. So it's the number of weeks times 52 minus the number of weeks. So if you give a 2-week vacation, it's 2 over 50. If you give 3 weeks vacation, it's 3 over 49, et cetera, et cetera. So just go back to your book and follow the formula to know how to make that dollar amount. But you're still going to have a debit to the expense and a credit to the liability to put it on the books. Then take off the books the liability with a debit and then give either cash, inventory, wages, something. All right. The next topic is a huge topic that I wanted to take some time and effort to make sure that it was right. So I have created this and spent hours and hours and hours on this. It's up on a website. So for this particular course, I put it in WebCT, and you can click on that link, go to the website, and follow the whole explanation. So there's a whole video explanation. Then there are 8 exercises that you can look through, make the calculation, and then there's a video response to tell you what the correct answer is and why. We also did it, a friend of mine helped me, Vladimiro, converted everything into Spanish. So it's quite a large project. I'd encourage you to go look at it. All right, thanks.